As you now know, the objective of Forex trading is to exchange one currency for another in the expectation that the price will change in your favor. More specifically, that the currency that you bought will increase in value compared to the one that you sold. But before we start looking at how to execute trades, first you need to have a really good understanding of lots, leverage, and margin, and how we then use all three of these combined to make a profit from the market. We'll go through a couple of really simple examples just to make sure that it's really clear exactly how they work together, because you'd be quite surprised at how many millions of people, they actually trade the markets with leverage. They don't really have any idea how it truly works. So currencies are traded in specific amounts called lots, which represents the units of base currency. Now, most brokers show the quantity in lots, while some brokers now show the quantity in actual currency units. So you just need to check and get familiar with how the broker that you use displays and quotes that. Now, one whole lot is called a standard lot, and this is equal to 100,000 units. A mini lot is 0.1 lots and is equal to 10,000 units, and therefore a micro lot is 0.01 lots and is equal to just 1,000 units. Now, a standard lot represents $10 a pip when using euro dollar as your base currency. So if you entered a euro dollar position with a one lot position size, what this means is that for every pip that it moves in your favor, you will make $10. But then for every pip that it moves against you, you will lose $10. A mini lot represents $1 a pip when using euro dollar as your currency, and then a micro lot would just represent 10 cents a pip. Now, if you want to buy 100,000 euros with US dollars, you would buy one lot of euro dollar. But some of you are probably wondering how on earth a small trader like yourself can possibly trade such large amounts of money. Well, let me introduce you to the wonderful and powerful world of leverage and margin trading. Leverage is the means of gaining exposure to large amounts of currency without having to pay the full value of your trade up front. Instead, you just put down a small deposit with your broker known as margin. So margin is the term used to describe the initial deposit that you put down to open and maintain a leverage position. Margin trading is simply the term used for trading with borrowed capital. And this is how you're able to open and control large positions with a small amount of initial capital. So if you're kind of struggling to get your head around it, all it basically is, it's the exact same way in which people go to the bank, they put down say 10,000, 20,000 pounds or dollars or whatever, and then the bank gives them a big mortgage on top of that. They give them the rest of the money to then be able to go and purchase property, right? When you go and get a mortgage, that's the bank giving you leverage depending on the amount of money that you initially give them. So that deposit that you would give to the bank is essentially the same as the margin that you put up with your broker, and they give you the rest of the capital so that you can then essentially control a large position size in the market. So if you were to buy one lot of euro dollar, you would be buying 100,000 units, right? Now, like I was saying, that's a lot of money to put up, but your broker helps you out by giving you leverage. So let's say you have a 100-to-1 leverage ratio. What this means is that you only have to put up 100th of that trade cost in margin to the broker as essentially a good faith deposit in order to control that large position. So in this case, that would only be $1,000 for you to control a $100,000 position. Now, when you close a leverage position like that, your profit or loss is based on the full size of the trade instead of just on the small amount of margin that you initially put up. Now, while that does magnify your profits, of course, it can also bring the risk of much, much bigger losses. So leverage trading, therefore, makes it extremely important to learn how to manage your risk, which is why we have an entire module dedicated to just risk management alone. When you know how to risk manage professionally, leverage will then become an effective tool to increase the efficiency of your capital when it's put to work, rather than it being a liability for increased losses, like how it is to the majority of uneducated traders. So leverage gives you large buying power with just a fraction of your capital. So let's quickly run through a couple of trading examples just to make it really clear of how leverage helps us to make money trading FX. So the first trade example will be trading without leverage. So let's assume that you buy half a lot, so 0.5 lots of euro dollar, which has a notional trade value of $50,000, because remember, one whole lot of euro dollar is 100 grand. Now, you don't use any leverage, so that's the same as a 1-to-1 ratio, right? And the margin required is the amount of money that you must essentially deposit with your broker to place the trade, which in this case is the full 50 grand cost of the value of the trade, because you don't have any leverage, right? So how that works in reality is that when you enter that trade, $50,000 of your account balance will essentially be frozen until you exit that trade. So in this example, let's say you have a great trade and you make a 300 pip profit, which equates to $1,500, because 0.5 lots is worth $5 a pip on euro dollar. So 300 pips multiplied by $5 gives you your $1,500 profit. But what if you don't have a $50,000 account? And even if you did, would you really want to put up your entire account on just one trade? What if your strategy calls you to take 2 or 3 trades all at the same time? Then you'd need $150,000 in your account. But even then, you'd be using the entirety of your available funds just to place those 3 trades. That is not intelligent trading. Fortunately for us, brokers recognize that not everyone starts with large trading accounts, so they allow you to leverage up your positions. And that really common leverage ratio is 100-to-1. And the effect that this has on your trade is pretty significant, right? So let's see this with a second example with the exact same trade, but now with a 100-to-1 leverage in effect. So because we now have 100-to-1 leverage, instead of using up all of our 50 grand on the margin, you only need to put up $500 whilst you are in the trade. So to calculate the margin required, you just divide the position value by the leverage ratio. So in this case, we divide 50,000 by 100, which gives us $500. So in the first trade example, without leverage, you had to put up 50 grand to your broker to earn a $1,500 profit on the trade. But on the exact same trade in the second example, with the only difference being that you use leverage, you still made the same $1,500 profit by trading 0.5 lots of euro dollar. But this time, you only put up $500 rather than 50 grand to place the trade. As you can see, this makes an enormous difference to your trading regime, as it enables you to take multiple trades at a time while keeping your risk minimized and the majority of your account balance disengaged from the market. So when trading on leverage, we need to think of your broker as a bank who essentially loans you the 50 grand to place a trade. And in this example, all they ask for in return is a $500 good faith deposit. And then upon closing the trade, that deposit is then returned to you, plus or minus the profit or loss that you make on the trade. Now, leverage varies dramatically with different brokers, ranging anywhere from 2-to-1 all the way up to 500-to-1. In some cases, I've even seen 1,000-to-1. Now, when you are trading with margin, your margin requirement will change depending on your broker and how large your trade size is. Now, don't worry about this right now because we're going to cover in depth exactly how to position size your trades and the tools that we use to quickly and automatically calculate everything. So there's practically no math calculations that you have to perform yourself. The brokerage platforms make it extremely simple for us to execute our trades correctly and pretty much automatically. There are various factors that come into play when deciding what amount of leverage to choose for your brokerage account, such as slippage, negative balance protection, capital partitioning, and then there's going to be country-specific regulations. But again, don't worry, all of this we will discuss in more detail in the following lessons. Now, having your $500 margin leveraged all the way up to $50,000 sounds pretty fantastic, right? Well, it is until you abuse it. High degrees of leverage means high potential profit, which leads to high amounts of greed, which then manifests low eventual success rates. The abuse of leverage is probably arguably the number one reason that traders end up blowing their accounts. It's a double-edged sword. Leverage magnifies your upside to the same degree that it magnifies your downside. Leverage does not increase your edge. It merely takes you to wherever you are going much faster. So what do I mean by that? Well, if you are an inconsistent or losing trader, Abusing leverage is not going to just suddenly magically make you profitable. All it does is amplify your losses to be even bigger. So in the risk management module, you're going to learn how to safely harness the power of leverage so that it works for you rather than against you. For the professional trader who effectively manages their risk, leverage is a powerful tool. But for the emotional gambler who tries to get rich quick, leverage is but a fatal attraction. So, just to quickly summarize the key points that we have covered in this lesson, currencies are traded in specific amounts called lots, which represent the units of base currency that we buy or sell. One whole lot is called a standard lot, and this is equal to 100,000 units. A mini lot is 0.1 lots, and this is equal to 10,000 units. A micro lot is 0.01 lots, and is equal to 1,000 units. Leverage is the means of gaining exposure to large amounts of currency without having to pay the full value of your trade up front. So remember, instead, you just put down a small deposit known as margin. A margin is the term used to describe that initial deposit that you put up with the broker to open and maintain a larger leveraged position. For a professional trader, leverage enables you to take multiple trades at a time while keeping your risk minimized and the majority of your account balance disengaged from the market. So in the risk management module, you're going to learn exactly how to keep your risk minimized at all times. So now we know how you can profit from buying or selling a currency pair using leverage. In the next lesson, we're going to look at how to analyze the Forex market so we know when to